So, Sisintle.
Oh, you want me standing? Okay.
As she did say that we met up at a hike and learn where we were speaking. I think I had my own reservations about accountants, right, when we started. And I was thinking that if I'm making, say for instance, I recently bought a property and it's cash flowing, let's say 1,000 or 2,000 on a monthly basis. And I'm going to Sisintle and I'm asking her, Uti, okay, how much do you charge? And she says 3,000. Looking at my annual income, she blowed half of it. So at first I was like, maybe I don't need an accountant. But as time went by, that's when you're like, okay, so say for instance, 5 years go by and you don't have an accountant yet. Remember, they need to first start looking at your income from when you started your business. Now, my accountant wasn't Sisintle, we hadn't met at that point. Our accountant sat down with us and he asked us that, guys, where did this money come from? Now it's a problem to start tracking from the previous 5 years. So what I would say is that, guys, let's get accountants on our team as soon as possible so that we can at least start good from day one. Without wasting any more time, then let's go into the questions.
Good morning, ladies and gents. I still remember the conversation I was having with Leo. That 5 years, now there was 2.5. The accountant is saying, where did this 2.5 come from? That's 5 years ago.
Imagine.
That's 5 years ago, so we need to start having these conversations. And I'm hoping that it's insightful. So yeah.
Not unless if you can remember 5 years ago, where did the 2,000 come from? Sure. Okay, so Sisintle, there were some questions that I had for you, right?
Yeah.
Now, there's, according to because remember, with every space, there's its own language, right?
100%.
So with SaaS, there's income, then there's taxable income, right?
Yep.
Okay, could you please just touch on the two for someone who doesn't know what's the difference between the taxable income and normal income?
So income is what is the cash flow that came into your business. Okay. That's what income is, right? Taxable income is post your in between, right? Depending on the model of your business, obviously. So there's a lot of deductions and subtractions and additions in between that happen. And then the final value that we get post the deductions that we spoke about is then your taxable income. So SARS doesn't, for example, you made income of $1 million, right? But then post the deductions, we find that the taxable income is only 750,000, right? That is the portion that you're taxed on and not the million.
Okay, so I'm not basically charged on the money that came into my account. We need to also factor in the deductions that went out.
100%.
Okay, I have a question for the audience, guys. Who hates credit? Who prefers buying cash? There must be someone who prefers buying cash.
Not that it's possible, but like, hey.
Okay. No, thanks for that. Right. Now you find out someone has about 10 properties paid off cash. Now when we're looking at SARS, what are the cons? I'd like to look at the cons because people are thinking cash is good because I'm not necessarily owing anybody. But now when it comes to SARS now is that looking at my expenses, because you did mention income versus expenses. Now when I'm looking at these properties, they're all paid for. Now how does that affect me every year?
Sure. I don't like telling people not to pay things cash, right? Because cash is key.
Yeah.
But sometimes it works against us.
Yeah.
I think the system is structured to work against people if they don't have any credit happening. So that means, unemali moswena. So let's get the money, you know?
Yeah.
So what they do is, with the property that you have, there's no money going out. It's already fulfilled, it's paid, it's fully paid, and all we're seeing is money coming in for that property. What am I going to do? I'm going to charge you on the money coming in because there aren't any deductions in between that you can claim for. That's the challenge. Yeah, Bo. I think that's the discouraging factor. But yeah, you can still claim for the small things, you know, your electricities, your da-da-da-da-da. But it's not the money going out to pay for that bond, basically. Yeah.
So can we go to the point that you made in terms of paying electricity, water, and utilities, of course, right? Now I'm looking at it from an investor's perspective.
Right.
The tenants are living in there, and I know that I can use this to my benefit at the end of the year, looking at it from SARS. But now, how do I position myself to then say, is it more of a thing whereby I have a conversation with them, they pay me and I pay, or how does it go? Because I'm trying to find out, it's a very tricky one when it comes to utilities.
Okay, so usually I've found that utilities, usually the bill usually comes to the investor.
Yeah.
It doesn't always go to the tenant, right?
Yeah.
So usually to manage it, it becomes that thing where you prefer the bill comes to you instead of it going to the tenant. So what I've seen a lot of agencies do is they'll be the middleman, right? As much as I'm renting and I'm living there, they'll generate something for me to see what happened in between. But you as the property owner will also have the access to see what happened in between, right? As much as the tenant is paying for those, I don't think you can claim. But unless, it becomes, I get what you're saying. It becomes tricky because I'm paying for the utilities. How do you then go get a deduction for that, right? It then becomes a me thing. Which it becomes,
Because it's very tricky. I'm looking at it also from structure.
100%.
Because now that money needs to come from my account directly, paying them. Because now if the tenant is paying, now I'm giving them the receipt. Does that also work in that way?
Okay. I want to say, if you pay the utilities from your account,
That's it.
you can claim for the utilities from your account.
Okay.
But if I, as a tenant, pay for the utilities from my account, then I can claim for the utilities. Do you understand? I think that's the simpler way of putting it. Whoever that has proof of the transaction happening on their account is the one that is able to claim the deduction.
You know, every time when you're speaking, especially about accountants and also law, we can't ignore the fact that structure plays a very important. In terms of, you spoke about trust, you also spoke about a company, and also there's personal. So now there's someone out there who doesn't understand the importance of these three. I mean, I'm a beginner. I'm here at Midrand and you're speaking about trust, you're speaking about company, PTY, LTD. In your experience, what would you say would be ideal as that first time, for the first time beginner, in terms of this is my first property? What would be more strategic to go about it, the strategic way?
What I'll say is stay away from being an individual or a sole proprietor to avoid the personal income tax. Because if you're going to be getting rentals that are very high, you're going to be charged very high, right? So rather go in as a company or a trust. Most people prefer, I don't like advising people on this because when it doesn't work out, and then it's like, and it's what I was always saying, or what I always say to people, Uguti, finance is not an umbrella thing where what I say covers everyone and it works for everyone, you know? It's customized, it's personalized, and that's why you need to have the conversation